Okay, so chapter 5, professional liability we were covering. Let's have a question on professional liability. So requirement of the question, there are two requirements, A and B. Requirement A, comment on whether auditor's procedures and conclusions were adequate. We need to comment whether the work performed by the auditor is adequate, proper or not. What is part B? We don't know. We'll see later on. Just finish part A first. So Domestica operate a chain of branches selling a range of domestic products on credit to the trade and for cash directly to the public. Audited financial statements show that profit were increasing in the last 3 years. And the latest profit for the year ended 31st December 20X1 were $550,000. Based on these latest accounts, obviously profit is increasing. An investor has acquired a controlling interest in the company for a sum agreed at 3 times the audited pre-tax profit earned in the year ended 31st December 2021. So based on the profit, multiply by 3 means 3 times he made investment to buy this company. The investor has subsequently engaged your services. Who are we? We are auditors. From day one in this class, we are auditors. We are having audit firms. We are not ordinary people. Okay. So has engaged your services to investigate the latest financial statements and the auditor's working paper. He's saying you need to investigate the latest financial statements and auditor working paper. We were not the auditor. The auditor who audited financial statements, his working paper, because he believed that the profits for that year were deliberately inflated and the auditors were negligent in performing their work. The auditor have agreed to allow a review of their audit files, working papers, and you have noted the following. And we need to see whether the procedures and conclusions of auditors are adequate, proper or not, whether his work is negligent or not. Can you read this number 1 and see whether auditor work is negligent or not? His work is negligent or not? His work is accurate, appropriate, adequate. Let's see. A review of all purchase invoices received in the 10 days before 31st December had been carried out. He is performing a cut off relating to purchases. Is that cut off relating to purchases? That's why he is checking what? Last 10 days invoices. If you are performing cut off, from where you should start your sample? From note GRN, then you should match with invoice and match with the ledger to make sure transaction have been recorded in their correct period as per GRN. He has taken sample from where? Not invoices. Okay. So 20 of these had been checked. He took the sample of 20 invoices, checked to the good received note GRN. He performed backward matching to ensure that goods had in fact been received. There are GRNs. And to payable ledgers to ensure that they had been properly set up as liabilities. And then he checked with ledger, yes, liability mean purchases, payables recorded properly. No errors had been found, mean there were GRNs available, there was entry in ledgers as well. And auditor concluded that all liabilities had been provided for, and he is saying purchases and payables are correctly recorded. So this was. He took a sample from here of 20. Match with the GRN, there were GRN available, and compare with the ledger, and ledger entries was there, and he concluded transaction completely recorded in their ledgers in their correct period. There is no issue. How many invoices he took the sample? 20. Now suppose company is having 25 GRNs. Suppose, and company is having 20 invoices, and all 20 invoices has been recorded into the ledgers. If he took 20 invoices, compare with that, obviously there will be matching GRNs available. Compare with that, obviously there will be 20 recordings in the ledger available. But these extra 5 GRNs against which no invoices, no accounting entry mean liabilities recorded, is that verified through this procedure? No. Instead, what should have been done? He should take the sample from GRNs and then compare with invoices and ledger balances. If you are taking sample from purchase invoices and the GRNs against which there are no invoices, no entry into the ledger, that we cannot verify through this procedure. For cutoff, we need to perform forward matching. What he did, backward matching. So missing invoices and entry into the ledger will not be verified through these procedures. So hence, chances that purchases and payables could be understated and profit stated. Is that? We can discuss this. How many marks are there? 15 marks, and we are having 4 issues. This means 4 or 5 marks we need to deal with each issue. Wrong. His work is negligent. Purchases, payables could be understated and profit overstated, that he is asked us to check. Can you identify number 2 whether there is an issue? A sample of 20 sale invoices and dispatch note had been examined for the last 10 days of December to establish that they had been dealt with in the right period. The auditors had found one dispatch note was dated January 22. How much sample you have taken? 20. Out of 20, 1 is relating to January. Is that? This means for one dispatch note, sale of January has been recorded in December. Means sale could be overstated. And whatever the result of sample, we apply to the whole population. If we discuss 1 out of 20, that is what? 5%. This means 5% sales overstated due to cut-off error. Okay. Management had explained that this was invoiced in December to avoid the additional VAT imposed by the government's budget, which came into force the day the delivery took place. Whatever is the order date, whatever is the invoice date, we need to see when risk and reward has been transferred according to the note, dispatch note. Sale should be recorded in that period. Is that even if you received amount in January, in December, but if goods have been transferred in January, the sale is of January, not December. You cannot record revenue in December. If you have received advance, you should record it deferred revenue, not revenue. The auditor concluded that the error was not material. It's 5% of sales and 1% or above is material. And that sales had been correctly accounted for. No, auditor conclusions were not adequate as 5%, 1 out of 20, 5% sales has been recorded in a wrong period. So sale is overstated. Chances that sale could be overstated as well as profit. Number 3. Four of whom agreed the amount. A circularization is a data confirmation. Circularization means data confirmation. So a circularization of 30 receivers accounts had been carried out by the auditor at the year end. Only 5 customers had replied. It's normal. Not all customers bother to reply. There are so many customers to whom we confirm they don't reply. But we verify other receivers through alternative procedures if they don't reply. So only 5 have replied. This means we perform circularization of 5 debtors. 4 of whom agreed the amount due to Domestica exactly. And 1 who, while agreeing the amount, amount is okay, stated that the goods had been bought on sale or return. And that it had not been decided at the time the confirmation request had been received whether to retain the goods or not. If you have delivered goods on sale or return basis, if you sell to the customer, inform us, pay us, we will record a sale. If you don't able to sell to the customer, this is our goods, we will take it back. And a sale or return basis, we cannot record as a sale until receiving confirmation from the customer he has sold to the final consumer. Is that? This means 1 out of 5. 20% sales are sale or return basis. Overstated. alternate test to ensure that delivery notes and invoices dated prior to the year end exist to support the remaining 25. So remaining 25 who haven't replied, we have verified they are accurate and they are genuine because their invoices, dispatch note, everything is available. Had been carried out with satisfactory result, the auditor concluded that a result of this test supported the conclusion in their system audit that good internal control exists over these areas and that sales and receivables figures, including the financial statements for the year, were accurate. 1 out of 5, 20% sale are relating to sale or return basis. So there is issue. So chances that sale and profit could be overstated. Number 4.
Outstanding balance is still out uncleared. That outstanding lodgement means uncleared sales, right?
None. It's not relating to check. They have recorded a sale and they are saying this is the sale of December that we deposited into the bank on 6th January. But this is a sale of December. But this company is doing, they are like a grocery store. They are like a grocery store. Christmas. On Christmas, whether these grocery store open or close depends on jurisdiction. Even if on Christmas shops are closed for how many maximum days? Maximum 2-3 days, not more than this. Even on grocery store, if people are sitting at home, they need to buy these products. They normally open even on Christmas. If they close just for maximum half or 1 day maximum, not more than this, because these are their busy days. For grocery store, Christmas is a busy day. Is that? Because people are sitting at home, ultimately they need more food. So what happened there? No cash count had been carried out by the auditor. Because in balance sheet, cash of 31st December is appearing, but we couldn't count the cash on 31st December. Okay, no issue. We can verify through alternative procedures. But in verifying the bank balance, they noted that an outstanding lodgement of $25,000 representing a cash sale in Christmas week had been lodged with the bank on 6th January. In company is saying this sale is relating to Christmas week, mean December, but we deposited this cash into bank on 6th of January. We are checking cash from where? Company records. And where is that cash? It's deposited into the bank. So we are checking through bank. So in bank, company deposit 25,000 cash at 6th January. And they are saying this cash is relating to sale of December. If from 1st January till 5th January, any deposit has made into the bank relating to January sale, then this sale is also relating to January rather than December. It's not possible you are depositing cash into the bank, cash you are collecting from the customer, obviously company need to deposit into the bank even on daily basis. Because if you keep cash in business, there is a chances of misuse, of fraud, theft. Even in busy days, you need to bank the cash more than one time during the day. This grocery store, they are receiving so much cash, they cannot keep cash in their store because there is always chances of misuse. So you need to bank. You need to bank on regular basis. And they have deposited into bank on 6th of January. And they are saying this is relating to sale of Christmas week in December. If the cash deposit into bank from 1st January to 5th January is relating to January sales, then there is no possibility this is relating to December. This is also January sale. Is that? They checked the amount of pre-numbered cash register summaries from store, and managing director confirmed these were the last summaries issued in December at each branch. I mean, this is relating to December sale. The auditor concluded that cut-off procedures for cash sales were properly carried out. And he just confirmed from the managing director. He said, okay, yes, this is relating to December, and he's saying there is no cut-off error. There could be cut-off error if cash depositing to the bank from 1st January to 5th January is relating to January sales. This is also relating to January. And auditor haven't performed the cut-off procedure properly. So chances that sales profit would be overstated by 25,000. In cash depositing to the bank 6th January, because we couldn't count the cash on 31st December, how much cash you are having. Obviously, at 31st December, if we haven't counted, afterward, we cannot count because that cash has been deposited into the bank. So they say, we deposited to the bank. So we can confirm from the bank from where? Bank statement. And we confirm from the bank, yes, 25,000 deposited into the bank that they are showing. But when it is deposited into the bank, not on 1st, 2nd, 3rd, 6th January, too late. So part A we have done. In all 1, 2, 3, 4, auditor work was negligent. Part B, prepare briefing notes advising your client whether he should pursue an action for negligence or not. I mean, whether the investor can take action against auditor. I mean, whether auditor is liable towards this investor or not. This investor is third party, not a shareholder. Because at the time of signing audit report, he was not the shareholder. He made investment based on your audit report. So he is what? Third party. Is that? And towards the third party, auditor is liable by meeting 3 conditions. Duty of care was offed. What does that mean? Auditor must be informed before signing the audit report that he is going to make investment based on the audit opinion. And there is no information about this in the particular scenario, whether auditor was informed before signing the audit report or not. In Caparo case, auditor was not informed before, so auditor was not liable. But in ADT versus Binder case, auditor was liable because he was having information. We can give case examples as well. Number 2, breach of duty. Mean he need to prove in the court auditor work is negligent. Yes, from part A above, we have found auditor work is negligent. And number 3, financial loss suffered as a direct breach of duty. Obviously, this investor have lost some of the amount that he has invested into the company based on company profit. But it is not clear whether the whole amount of investment is he lost or not lost, whether auditor is negligent and liable for the full damages or not. Because if auditor proved in the court, he tried to buy this company to gain any competitive advantage. because he was having similar other businesses, and to gain competitive advantage, he had to invest in this business. He had to buy this business. Then whatever was the profit he was investing, then the decision was not based on audit opinion. So in that case, auditor will not be liable. Even if we see in part A above, there is not a huge difference between profit. I mean, profit might be overstated, but not with a huge amount. So even if auditor will be liable, he will be contributory liable, not for the full damages. So these we need to discuss in part B. So moving forward, we have discussed whether auditor is liable towards third party or not. We have discussed methods of limiting liability. Auditor can limit liability. Let's discuss avoiding liability, how auditor can avoid liability. Auditor can avoid liability if he perform his work according to standards. He's not going to compromise his quality of work. Ultimately, he will not be committing negligent work, so he can avoid liability. If he maintains quality of his work, he can avoid negligent reporting as well as liability. If there is no negligent reporting, wrong reporting, there will be no liability. But for that, he need to maintain quality of his work. How auditor can maintain quality of his work? By complying with ISQC 1, International Standard on Quality Control 1. In this standard, providing guidance to the auditor how he can maintain quality of his work. And there is another standard on quality control, that is ISA 220. Both standards saying similar points, but standards are different. ISQC 1 need to apply at firm level, while ISA 220 we need to apply in individual audit. The headings of both standards are same. I mean, there are some policies that a firm need to follow to maintain quality of his work, that is ISQC 1. There are some policies that auditor need to follow in individual audit to maintain quality of his work, that is what ISA 220. So what is this ISQC 1 or ISA 220? Let's discuss in next chapter 6. So there are 7 ISQC 1 quality control policies procedures. What we are going to discuss, quality control policies and procedures. As per ISQC 1. So auditor firm or auditor can maintain his quality of work and avoid wrong reporting, negligent work if they follow these 7 quality control policies procedures. What are those? Leadership responsibilities, ethical requirement, acceptance and continuous of engagement, human resource, engagement performance, monitoring, and maintaining adequate documentation. Leadership responsibilities mean there must be a leader of the firm. There must be a leader of the firm who should monitor everybody working in the firm, whether they are complying with law regulation properly, whether they are complying with the auditing standards during their work or not. If there are no leader, people don't follow the rules. Same like our home. If our parents are at home, we obey the timings, we obey the rules. We reach home on time, we leave home on time, we are having food on time, we are having sleep on time. But if there are no parents at home, we feel liability. We don't observe the timing. We are coming to home back late night, we are leaving early, we are not having any timing of sleeping, we are not having any time of food. So in the similar manner, in a farm, there must be a leader. A senior partner should be there who should monitor the working of every auditor, whether they are complying with the law regulation, whether they are complying with auditing standards during their work. There must be ethical requirement, mean firm should make sure everybody is following codes of ethics. And we are managing the threats on independence properly. If any threat is unmanageable, we are avoiding that. Because auditor work is compromised most of the time due to threats on independence. That was the issue in Enron case. My auditor were involved in fraud because they compromised their independence due to self-interest fee dependency threat. Acceptance and continuous of engagement. Before accepting audit of any client, we should perform some procedures. And based on the positive results of those procedures, we should continue the engagement. We should check our qualification, legally, ethically, both point of view. We should check adequacy of resources, because due to lack of resources, you could compromise your quality of work. We should check limitation in scope of work, because if there is any limitation in scope of work due to pressure, you could compromise your work. We should obtain professional clearance from previous auditor. We should obtain client identity, because these things could compromise our quality of work during the audit. That's why before accepting audit, we should perform some procedure, and based on those procedures, we should continue the engagement. Human resource, not only we should be having qualified, competent, experienced human resource, we should maintain human resource as well. And how we can maintain? Through CPD, continuing professional development. I mean, whatever the new changes coming into the standard, we should put into the knowledge of our staff by conducting different seminar, different coaching classes, so that they must be working as per the recent knowledge of standards. Competent, qualified people, not only we must be having, we must maintaining their knowledge. Engagement performance mean before starting audit work, there must be audit planning. We need to plan audit work. Audit planning mean we should prepare audit strategy. Audit strategy mean we should highlight risky areas, and then we should prepare audit plan. Audit plan mean direct the work of auditing. If there is no direction, there is no strategy, we will not be able to conduct audit within time, within cost, or on quality basis. We will stop during the audit. That's why there must be proper direction of the audit. What should be there? Proper direction of the audit based on audit planning. And this area we will discuss in more detail in next chapter, audit planning. There must be monitoring of audit work. In senior, junior work should be monitored by the supervisor. Supervisor work should be monitored by the engagement partner. Mean there must be review of audit working paper. There are two types of working paper reviews. One is called hot review, and the other is called cold review. Cold review is also called QCR, quality control review. Hot review is part of audit process. It is performed by the engagement partner before signing the audit report. He reviews the working paper prepared by the team to see whether all planned work has been performed, whether all evidence has been obtained, there is no work required, and then he signed the audit report. This is called hot review, before signing the audit report. Cold review is after signing the audit report. When you have completed your audit, you should send working paper of your audit to any of the independent partner of any other firm or any of other firm or office of your firm, so that you should have reviewed quality of work. If there is anything lacking, we can improve in future. And this is also called quality control review. This is also performed by your professional body as well. Not every year, at least every 3 years, we need to submit our working paper to the professional body. They check the quality of work, whether we are conducting work as per standard or not. So there must be monitoring of the audit work so that if there anything lacking, the senior person will highlight that we can improve and we can avoid negligent reporting. There must be adequate documentation. Documentation means we need to prepare working paper of our work. Not only we need to prepare working paper, we should retain those working paper for next 5 years in our record. I mean, whatever auditor is performing, he need to document. Why? Because this is the only evidence on which you can prove your opinion. So how a firm can maintain quality of their work? By following quality control policies and procedures. What are those? Leadership responsibilities, ethical requirement, acceptance and continuous of engagement, human resource, engagement performance, monitoring, and adequate documentation. ISQC1 is covering at firm level, mean firm must be having a leader. Firm should follow ethical requirements. A firm must perform some procedure before accepting the audit. A firm must be maintaining human resources. A firm must perform audit planning of each audit. A firm must review working paper of the work performed, and a firm must maintain adequate documentation. ISA 220, that is also standard on quality control, but that is relating to individual audit. But they are saying in individual audit, there must be a leader who is monitoring the work of auditing. In individual audit, we should follow codes of ethics and manage threats on independence. In individual audit, we should perform some procedure before accepting and then continue the engagement. In any audit, we must be having proper human resource. In any audit, we must plan our work. In any audit, there must be monitoring of the auditing work. And for each audit, we need to prepare proper documentation. And they are saying similar things, but ISQC1 is applied at firm level. ISA 220 is applied on individual audit. ISAs we need to follow during audit. ISAs we need to follow during audit. While this ISQC1 is relating to a firm. I mean, if you are running a firm, you must follow these quality control policies procedures to maintain quality of your work. So let's move towards a good question on these quality control policies procedures. Yes, question number 9. So 20 marks question, comment on these findings. 1, 2, 3, 4, 5, 6, these are findings. Comment on these findings in the context of CAML's quality control policies and procedures. And we need to highlight issues relating to quality control policies and procedures. Let's discuss. You are responsible for monitoring your firm's CAML and company quality control policies and procedures, generally, and their application to specific audit client. I mean, big firms have appointed a quality control manager as well, whose responsibility is to check quality of the work of different audit assignment. In whatever auditor is performing, they are submitting their working paper to quality control manager. And he is checking whether team is following standards or not, they are maintaining quality of their work or not. So you are responsible for monitoring your firm's quality control policies and procedures generally and their application to specific audit client, and you have selected for scrutiny a newly acquired client. GERMS, a company providing specialist laboratory services in the food hygiene industry. And you have selected working paper of a client who is a newly acquired client, GERMS, and they are operating in laboratory services. The first year audit is nearing completion, and you are visiting the auditor team located on the client premises. Audit is nearing completion. And after year end, we take about 2 to 3 months to sign the audit report. This means probably 2 months after the year end, we are visiting the client. The draft accounts jumps for the year ended 31st December 2022 show turnover of 20 million dollar. This is dollar. While in previous year 20x1, it was $15 million. The total assets of $7 million, while previous year it was $4 million. If you see, company turnover has increased from 15 million to 20 million this year, about 33% increase. And total assets have changed from 4 million to 7 million, near about 40% change. 40%? No. From 4 to 7, above 70%. In fact, above 80%. From 4, they have changed towards 7. The audit team comprises an audit supervisor, senior, and 2 trainees. The result of your visit during February, it's February 2023, year end was 31st December. In probably 1.5 months after the year end. Even if we see mid of February, so 1.5 mean about 45 to 50 days after the year end. And review of the audit working paper for the year end 31st December 2022 are as follows. Can you see in number 1 whether there is any issue of quality control policies procedures? What else? What else? In the analytical procedure section of the planning memorandum, at planning stage, we perform analytical procedure, mean compare current year financial statements data with the previous year. Why? To highlight any differences. If there is too much difference in any of the account balance, so that we highlight as risky area. Is that? So in the working paper, in the planning memorandum in audit plan section, in analytical procedure section, it is written, the audit senior has stated not applicable new client. This analytical procedure is a compulsory part of planning. We must perform in planning of each audit because based on that, we can highlight risky areas. Even the client is new or old. This we need to perform per ISA 300 audit planning, as well as there is a ISA 520 on analytical procedure. These 2 standards we will discuss in next chapter. We must perform. So this is poor direction of the audit. This is what? Poor direction of the audit, not performing. The audit supervisor has not signed off the planning memorandum as having been reviewed. if one audit person is performing any work, the other senior person has to review it, and both persons who has performed the work and who has reviewed, their signature should be on the working paper. And here supervisor haven't signed the work. This means the review has monitoring of the audit work has not been done properly. So there is issue of monitoring as well. And audit planning is a high level activity. Our whole audit is based on the planning. And it must be performed by key audit personnel. It is beyond the competence of senior, junior, and who has performed planning here. Senior. So we haven't assigned the proper human resource here. This should have been performed by key audit personnel, engagement partner, and audit manager. So there is issue of poor direction as well. There's issue of monitoring of the audit work as well. And there is issue of what human resource as well. We haven't assigned the appropriate human resource. Poor documentation, even you can say if there are no signature, so there is poor documentation as well. We are learning how to apply this standard. Number 2, can you identify the issues?
Can you please introduce it? Like of monitoring?
The audit supervisor is currently overseeing 3 other assignments. Working from Camel Company's office. Okay, if he can manage work and both all other clients are having different year end, then he can supervise more than one client. But if they are having a same year end, then he will not be able to supervise properly. There is a lack of human resource. He last visited Germ's office when the final audit commenced 2 weeks ago. Oh my God, in final audit, we need to perform too much work. And supervisor must be there because to verify balance sheet item having huge amount, significant amount, supervisor is a most competent person. But he didn't visit from last 2 weeks. This means poor monitoring of the audit work, as well as there is issue of human resource companies lacking supervisors. Since then, the audit senior has completed the audit of tangible non-current assets, meaning last 2 weeks, 14 days, he performed work on non-current asset only, amounting to 1 million, while previous year the figure was the same 1 million. I mean, there is no addition, there is no disposal of non-current assets, and he has spent how many days? Weeks, 14 days. So this is wastage of audit resources. This means poor direction of audit work. I mean, his work was not directed. Which area we should verify, how much and how. I mean, might be his work was not directed, not properly defined. Because this is the area that we can verify within 1-2 hours maximum. Because there is no change. If we were the auditor in previous year, just we can review the previous working paper. No need to perform further procedures. So poor monitoring, lack of human resource, and poor direction of the audit. We are wasting resources. Number 3.
Improper allocation of human resource and monitoring.
One of the trainee has just finished sending out data synchronization. How many normal data days companies are having? Data days mean companies sell goods on credit basis to customer. Or how many maximum days companies sell on credit basis? 30 to 45 days maximum. This means if any of the balance recorded as receivable at year end 31st December, company will recover that amount within the next 30 to 45 days. Is that? This means if we want to confirm balance from the debtors, we should confirm near to the year end. If we are confirming from the customer after too late, customer will never ever agree with the balance because might be he has paid the amount has already been settled. So what happened? One of the trainee has just finished sending out data circularization when? Mid of February. After about 45 to 50 days of the year end, trainee has just sending the circularization. Too late. Requesting confirmation of a balance at 31st December 20x2. The data receivable balance at that date were 4 million, while previous it was 2 million. There is a 100% change in data. And if we compare 4 million along with the total assets of 7 million, this is a highly material account balance. And when he is performing circularization after 45 to 50 days of the year end, so here customer will never provide positive response. The auditor cannot receive a positive response for this circularization because customer will say, no, I don't have this balance. But you will say, oh, receivables are overstated, while in fact might be customer have paid the amount because you are performing procedure too late. So this is what poor direction of the audit mean. These things should have been defined in audit plan. These are the high risk area. So we should perform circularization till this date. How we should verify this mean the audit approach, what procedure auditor need to perform. Everything is written in the audit plan. This means there is poor direction of the audit. But also who is sending circularization? Any human resource. This is a highly risky area, highly material area. If not supervisor, at least senior should have been assigned to perform this work. So there is lack of human resource that you have assigned on this high risky, highly material area. Is that? Number 4, please.
planning, financial, inadequate documentation.
So the company's accounts payable clerk keep a petty cash float of 3,300 to meet sundry expense, petty cash, routine expenses, and these are monthly. If we multiply by yearly, so that will become about 3,300 multiplied by 12, 36, about 39,000. Okay. Though 39,000 is immaterial from financial statement point of view, but it is material from petty cash clerk point of view. The audit program shows no record of a cash count. Cash was not counted. And on inquiry, it is explained to you by the audit senior that when she sent one of the trainee to do the count payable clerk stated he was at that time too busy and that the trainee could do the count the next day. Sometimes we accept these kind of requests of client if their integrity is not doubtful and they are having good internal control system. The audit senior, but if we send according to the audit plan staff member to count the cash and he received this kind of response, so he should record everything in the working paper so that the next day we should send any other staff member to count the cash. If it is not recorded in the working paper, everybody will assume this has been performed. So the audit senior decided to postpone the count until later in the audit. So he decided to postpone the count until later in the audit. None of this is recorded in the audit paper and nothing is recorded in the working paper. So this is poor documentation first. And then audit program shows no record of cash count and on inquiry, if this was not performed or not recorded, supervisor should have checked this whether these procedures have been performed or not. If not performed, he should have asked to other staff member to perform that. So there is poor monitoring of the audit work as well. He is not monitoring anything. To whom we have sent trainee, again human resource issue, cash, highly sensitive area. So at least a senior have been assigned rather than training. So there is no appropriate human resource have been assigned in this area. And this could be again due to poor direction. Because in direction we said who should audit what area, why training is going. This means in audit plan you have written this person will check this. Mean you haven't assigned appropriate human resource. So there is poor direction of the audit. Number 5. The other trainee was assigned by the audit senior to the audit of inventory, which comprises consumable stores amounting to 200,000. While previous year it was 150,000 inventory. And there is huge change from 150, it has changed to 200,000, 33% change. And if we check 200,000 from financial statement point of view, though it is immaterial, but the change is material. To whom we have assigned? Trainee. So HR, human resource issue is there, at least senior should have been assigned. The firm missed the company's annual inventory count because it was only appointed auditor after the company's year end. Okay, what we need to do? At 31st December, whatever is the year end, we need to check inventory. How? At this date, we must perform count of inventory. We should not count. We should ask the client to count the inventory and we will observe whether that inventory is available over there or not. After count, What is the purpose of count? After count, against count sheet, we need to adjust PIR, inventory record. Because the figure going into financial statement is from PIR. So through count sheets, what company should do? They should compare count sheet with PIR to see whether PIR is having a similar item. If not, they should adjust PIR. And adjusting PIR against account, this is the main purpose of count. If we are unable to attend physical count at year end, then how we can verify inventory? The time after the year end where we are available, we should ask the client to perform count. Suppose in January or 10 days after the year end, 15 days after the year end, we should ask the client on first instance to perform count and adjust PIR. And if there is any difference between counted inventory and PIR inventory, adjust PIR. And then what we need to do, the inventory from this count date to year end, how we can arrive at year end inventory. The inventory that was deducted during this period, that must be added back. And the inventory that was added, that must be deducted back. And then we will be able to verify year end inventory. And this test, added back, deducted back, is called rollback test. If auditor is unable to attend inventory count at year end, so after year end, he should request the client to count the inventory and PIR must be adjusted. And using rollback test, he can verify closing inventory at year end from the record. What happened here? The other trainee was assigned by the audit senior to audit of inventory, which comprises consumable store amounting to 200,000, while previously it was 150,000. The firm missed the company's annual inventory count because it was only appointed auditor after the company's year end. The trainee has performed a test of control over purchasing and inventory issued and roll back a sample of current quantities to the year end quantities. And he checked there are controls accurately working. And he roll back the mean from this date inventory balance to year end balance. Whether this has been performed, count and PIR adjustment. No. If you will roll back, ultimately you will be finding the same figure that is appearing in the financial statement. Whether that inventory physically exists or not, this is not verified. So this is what? Poor direction of the audit work. How to verify inventory if we are unable to attend a count at year end, mean direction was not properly defined. And there is an issue of human resource as well. We can say poor monitoring of the work as well. Because if the direction is not proper, or might be direction was proper, he haven't performed the work properly. So there is a poor monitoring of the work as well. Through monitoring, these kind of negligence can be highlighted and corrected. So number 6, the company proposes to include an environmental report in its annual report containing a health, safety, environmental, and social data for the year ending 31st December 2022. So company is going to provide CSR reporting in the annual reports. This is what other information is that we need to read review per IAS 720. A copy of this report has been filed with the audit senior. By the audit senior, mean a copy of CSR reporting is filed in the working paper by the senior, with the comment that it will be dealt with when the other unaudited information to be included in the annual report is available for review. He haven't read that report, he haven't reviewed that report, he just punch with the working paper with the note. We will see this later on at the end of audit when we will review other information, when annual reports will be prepared. No, if you are receiving any information, any other statement relating to annual reports, the moment you are receiving, you need to read review. Just to identify any inconsistency with the financial statement. That could lead towards a misstatement in the financial statement. That could provide you any extra evidence relating to a misstatement in the financial statement. So this is what first, this is poor direction of the audit work. I mean, it should have been directed at start of the audit, like companies are doing this. So whenever we are receiving this we need to check. What else is there? Who added this to the working paper? Senior. So there is human resource as well. This is highly sensitive area. In high level area that should have been reviewed by the auditor senior, key auditor supervisor, key audit personnel rather than the senior. So there is issue of human resource as well. If he haven't reviewed this for ISA 720, then while reviewing his work by the supervisor, he should have reviewed this, but it was not done. This means there is no monitoring of the audit work as well. And that's it for today.